Welcome back to Lutamarkets. Today's lesson is all about liquidity concepts, one of the most crucial elements of understanding market structure. Liquidity drives the markets, and if you can identify where it resides, you'll have a significant edge in timing your entries and exits with precision. By the end of this video, you'll understand. White heavy checkmark what liquidity is and where to find it. White heavy checkmark the difference between Buy Stop Liquidity, BSL, and Sell Stop Liquidity, SSL. White heavy checkmark how liquidity zones like trendlines, equal highs, lows, and ranges shape market behavior. White heavy checkmark critical signs of a failing point of interest, POI. Stay tuned, because we'll also break down these concepts on live charts, so you can see exactly how they work in real-world trading. Let's dive in. What is liquidity? At its core, liquidity is where stop-loss orders exist in the market. These stop orders are essentially pools of money that smart money, banks and institutions, use to execute their trades. Here's why liquidity is so important. Liquidity fuels the market. For smart money to enter or exit large positions, they need to activate stop-loss orders to create the necessary volume. Wherever stop-losses are clustered, liquidity exists. Now, liquidity comes in two main forms. Buy Stop Liquidity, BSL. This is found above key levels, like swing highs, and originates from the stop-losses of sell orders. When price takes out BSL, it often reverses downward because institutions use this liquidity to place sell orders. Sell Stop Liquidity, SSL. This is located below key levels, like swing lows, and comes from the stop losses of buy orders. When SSL is taken, the market typically reverses upward as institutions use this liquidity to place buy orders. Types of liquidity zones. Now let's talk about the different types of liquidity zones you'll encounter in the market. Swing point liquidity. Swing highs and lows are classic liquidity zones. For example, a bearish market might take out a swing high, BSL, before reversing downward. In contrast, a bullish market might take out a swing low, SSL, before pushing higher. Equal highs, equal lows liquidity. When price forms equal highs or equal lows, these areas act like magnets for liquidity. Institutions target these levels because they know retail traders often place stop losses there. Trendline liquidity. Trendlines attract liquidity because retail traders frequently use them for entries and stops. When price runs a trendline, it often takes out the liquidity resting above or below it before reversing. Range liquidity. Inside a price range, liquidity builds up at both the highs and lows. Smart money typically targets one side of the range before reversing to the other, creating sharp moves. Liquidity plays a significant role in how the market interacts with points of interest, POIs, such as order blocks or fair value gaps. During POI creation. When price approaches a potential POI, it often takes liquidity first. For example, if the market wants to form a bearish order block, it might run Buy Stop Liquidity, BSL, above a swing high before reversing downward to create the POI. During market return to POI. On the way back to a POI, the market may again take liquidity, this time, Sell Stop Liquidity, SSL, before reacting at the level. These behaviors highlight the importance of watching for liquidity sweeps near POIs. They can signal high probability trade setups. Not all points of interest hold strong. Here are three critical signs that a POI might fail. Multiple retests. If price keeps returning to an order block or another POI and each reaction becomes weaker, it's a sign that liquidity at the level is being absorbed. This makes it more likely that the POI will eventually break. High volume with limited movement. When you see high trading volume around a POI but little price movement, it suggests that institutions are offloading or accumulating positions. Once they finish, the level often breaks. Formation of liquidity above or below the POI. If equal highs, equal lows, or stop clusters form just beyond a POI, it can attract price to break through the level, turning the POI into a liquidity trap instead of a reversal zone. How to trade liquidity concepts. Here's how you can apply these liquidity concepts in your trading. Identify liquidity zones. Mark swing highs, lows, equal highs, lows, trend lines, and range extremes. These are the areas where liquidity is most likely to reside. Look for liquidity sweeps. Before committing to a trade, wait for the market to sweep liquidity at one of these zones. This is often the precursor to a significant reversal or continuation move. Combine with POIs. Align liquidity sweeps with points of interest, such as order blocks or fair value gaps, to increase the probability of your trades. Confirm with market structure. Use break of structure, BOS, or change of character, COCH, to confirm that the market is shifting direction after a liquidity sweep. To wrap it up, liquidity is the fuel that drives the markets. By understanding where liquidity exists and how the market interacts with it, you can anticipate sharp moves and position yourself on the right side of the trade. Remember, liquidity is found where stop losses cluster. Smart money targets these zones to execute their trades. Always wait for a liquidity sweep to confirm your entries near POIs. Up next, I'll show you live chart examples to bring these concepts to life. Watch closely to see how liquidity sweeps and POIs align to create high probability setups. If you found this video helpful, hit like, subscribe, and turn on notifications to stay ahead with more advanced trading strategies from Lutamarkets. Let's dive into the charts now, and as always, stay sharp and trade smart.